Hi, this is Ken Boyd with the Accounting Accidentally website, and this is the second of two videos on revenue recognition in 2020. And I have a link at the bottom of the page to a great PwC discussion of this topic where you can find more information. Remember that you can go to Accounting Accidentally for over 350 blog posts and links to over 400 YouTube videos. So, this is a question that's a common one, and it's a good way to explain revenue recognition. These concepts are common. Acme Manufacturing signs a $7 million contract with Greenfield School District to build a new football stadium on March 1st, 2020. We're going to see that date again in a minute. The contract includes two parts. The first is $2 million for a grass football field and track. The second is a $5 million fee to build seating and a press box. Acme is required to complete the field and the track construction on June 1st and finish the seating in the press box by August 15th. There's also some bonus money in it for Acme. If Acme finishes the field and track construction on May 1st, Greenfield, the client, will pay Acme a 10% bonus on the $2 million price. The same is true of the seating and press box component. Acme will earn a 10% bonus on the $5 million fee if construction is completed by July 15th. This is a very common arrangement. Where I live in St. Louis, the main east-west highway through St. Louis City was renovated about 10 years ago, and the construction company earned a very large bonus for finishing the project early. Obviously, you want a highway open as soon as you can, so there was a pretty attractive bonus to the builder. So I use this question to explain a couple of performance obligation points. Which of the following is incorrect? A, the performance obligation is a unit of account used to measure revenue recognition, and that is true. So think about obligations. What does the person have to do to get the revenue? B, a contract can include more than one performance obligation. True, in this case we have two of them. C is false. D, for the purposes of performance obligation, a contract can be either written or oral. That goes back to an old business law question you might see on the business law part of the CPA exam, or that you might see in an undergraduate business law class. Contracts can be written or oral. That same concept applies here. So what about the bonus? In other words, what about calculating revenue based on the bonus? And what I say here is that Acme, the builder, is not able to reliably estimate whether or not the firm will earn the bonus when the contract is signed on March 1st. They can't reliably predict it. The principle of conservatism, a big issue in accounting, dictates that the bonus should not be included in the transaction price on March 1st. That is, you don't count the bonus as revenue when you sign the contract. And thirdly, when does revenue get recognized? The field and track revenue is posted on June 1st, and the seating and press box revenue is posted on July 10th. In both cases, revenue is posted when work is completed, because that's when your obligation, your performance obligation, is completed. So that is when you post the revenue. We covered how much revenue you post, and we also covered performance obligations. If you want to find out more, here is the website address and the part of the web page for revenue recognition. If you want to go out to the FASB and find out more, you'll see in italics at the bottom, revenue from contracts with customers, topic 606. And finally, remember that for blog posts, videos, discussions, live chats on accounting, conferenceroom.mn.co, you can join for free and get a lot more information. Thanks for watching, and we'll see you next time.